Welcome to the Best of US's weekly review, where we review the Friday swing trading call and the Kerry's call as well in the afternoon on Friday. Well, this week on the Platinum call, we had a special guest, Mr. Rob Hender, who is 31 years in the mortgage industry and is a developer of mortgage divisions for banks, in which he is involved in this as of right now. And he gives some great insight to what is happening. Along with, during Kerry's call, he talks about the evolution of the semiconductor wafer and how it's going to dispense heat with a new product that is going to change how these semiconductors are created, along with a couple other tidbits about the Russell 2000 and the market. So let's get going.
It's hard for a human being to look at those loans and look for outliers, look for issues, look for potential fraud, look for potential fair lending exposure, right? I mean, you can dig into spreadsheets and you can pay a really smart kid with a statistics degree 100 grand to find those issues. Or now, I can take that spreadsheet, upload it into Chat GPT, and say, here is a spread of interest rates every day. Here is the loans we made. Do you think I discriminated against anybody? And guys, I'm going to tell you, I don't know how the hell it does it, but it knows. I mean, it speaks English, and it's the smartest damn thing in the world. So those are places, Trent, that I think you're going to see. You're going to see AI replace that smart kid that just came out of a school and he's getting an analyst job. That's a lot of banks have analyst jobs, and that's what I think you're going to see replacing pretty readily.
Yeah, but AI, you got to look at it. AI lies very well.
It does. At the end of the day, you have to rule it. Yeah, no, there's no doubt, Bob. I'm on the board of a nonprofit organization. I had to draft a document, and I needed some statistics on default rates on mortgages for minority borrowers, and I literally in my document I put a placeholder in there, and I just said the default rate is 15%, and it's like 4%. About 2 months later, I came back and was working on that, and it said my online research indicates that the default rate is 15%. I'm like, oh shit! It just gave me back my placeholder. Yeah. You do have to be careful.
Yeah, garbage in, garbage out.
Yep.
He does. He totally does. So, Rob,
I have a question about, do you monitor delinquencies at all, Rob? Are delinquencies going up in payments, or have we hit that yet?
So we do, Mark, except that I will say it's a little bit distorted. I'd hesitate to make any decisions based upon mortgage delinquencies on anything. As we came out of the pandemic, our industry, forever, our industry had a pretty mortgage banking particularly had a pretty standard collection process and default process. The pandemic and the forbearance process kind of taught the industry that maybe there's a better way to do it. In the past, you had to go 60 days delinquent before we even talked to you about a modification or a short sale or something like that. We made you damage your credit before we even talked to you. Now, on the heels of that, we're a little bit more amicable and having discussions. So yes, the delinquencies are, not universally. Like FHA is up, conventional is down. As terrible as that sounds, what that means is your entry-level first-time home buyers, low to moderate income earners are hurting, and then your mid-class to upper class are suffering less. That's probably the best way to answer that question.
So I bet that probably directly relates to the increase of inflation, and people are not seeing that increase in their paychecks, so they're having to make decisions on discretionary payments, basically.
Yep.
Gallium nitrate. What the hell is that? That is something you will put on a silicone chip to cause it to reflect more heat. And he says we are set up so that we can test gallium nitrate semiconductors or wafers in the future. And that is the future of wafers. You've never heard that anywhere else, except on the earnings call of AEHR. Well, who owns the patent for putting Gillian nitrate on wafers? This company right there, Navitas, a $3. I own it at $3.81. It's at $4.07. He told us that this is where the industry is going. How did I was there listening to the earnings call. No one else has ever mentioned this other than the people at Navitas. And obviously at $4.77 a share, no one's paying any attention to them. So these are the places. And again, SoundHound. Nobody wanted any SoundHound. And now who is it that bought Chrysler, is putting in the Volvos and everything. That was announced yesterday or the day before, and the stock is going crazy. How did I know that SoundHound? Because Jensen told me. And that's going to be how the technology that Apple, Google, Microsoft has mastered and built empires out of, how it will come to us. And we will duplicate what they do. And we won't need to refrigerate, because we don't need GPUs to set up what I want to do for this company. I don't really need a GPU. I just need enough CPUs to gather all you people's information, and then to gather the stocks that I want to trade in, and then scrape the internet of all the data that is written on them, and have that computer analyze it for me. It may cost me, it may be a $20,000 computer, but what I'm saying is all businesses will have that $20,000 computer, but it may be sitting in your grocery store, or that empty building that has a nice that's in a strip center, has a nice concrete floor, a good solid roof, is air conditioning, is well lit. We are going to duplicate what Google, Microsoft, Apple, and Meta has done. But we're going to do it in our community. And we're going to become billionaires from it. You look at anything. Only the rich could afford automobiles when they first came out. Only the rich could afford to fly in an airplane. But it really doesn't become an industry until you and I get involved in it. That's what's going to happen. So all those stores all those offices that are not being occupied, they're going to become data centers. They may only have 10 servers in them, but they're going to serve 50 businesses and bring them into the world we live in.
I think you're seeing the signs of this, free for all lending happening in China this week. They have, from what I've read, they've had 40 banks fold up in China last week.
Really?
And most of these banks are small outlying banks outside the big cities. And the whole Evergrande explosion in real estate in China, these banks all of a sudden are folding. And different from our system, where we have FDIC insurance on our checking and savings accounts and CDs, in China that you don't have that. So these banks who have checking, savings, CDs, whatever, all of a sudden are like closing doors, and those people who have money sitting in their checking account, it's gone. Well, what they're doing is it's basically being all wrapped into a government program who's absorbing it. But I think if, different from here, we have those guidelines that protect our checking and savings accounts. But I think it's is that contagion that's happening in China, will that roll across Europe and into the United States, westward, and will we see ramifications of a banking collapse in China, and will it come to our shores in some way or another? I gotta believe there are some major banks based in the United States who have done loans or done business in a lending capacity in China, and will that come back to some of the bigger banks here? So I don't know. It's more of a statement of what's happening, but
Yeah.
I've got to believe, the high cost of borrowing for the consumer, the high cost of living is eventually going to trickle down into our financial institutions.
And so you saw kind of a rotation. You saw a rotation out of the mega cap stocks, and then you go into the Russell 2000 small caps. You saw those things just knock it out of the park. So people were saying, "Oh my gosh, we can go and start investing in the rest of the the 900 or 493 stocks in the other part of the S&P and the small caps 2000." So the weakness in these large tech shares yesterday came, because of the consumer price index showing cooling inflation, which really wasn't cooling in my eyes. It was down a little, but still rising. And that fueled the hope for a September interest rate cut by the Federal Reserve, even though the Federal Reserve governors are saying, no, we're not going to do that right away. We're going to wait for the data. So the rate cut expectations in turn had the markets selling the tech winners, okay? And then they took those shares and they went to places like, if you looked at home builders yesterday, we looked at them in the live chat, and if home builders went up, pool suppliers, anything that benefited from lower interest rates really took real estate took a higher look yesterday. All 7 technology stocks were off at least 2.3% yesterday. The activity translated to $598 billion single day collective loss of market cap for that group, the biggest wipeout since a $602 billion loss on February 3rd in 2022. So basically, I'll show you this chart and what happened. If I can share. Nope.
There you go.
There you go. Thank you.
Yep.
Okay, thank you. So what that did a little bit is we've been watching the market weight S&P, okay, versus the equal weight S&P. And you can see what happened the last 2 days is that they've been kind of diverging for a while. And with yesterday, you saw a rotation out of the big techs, and you see that the equal weight has now risen up, even though now today we're seeing with the techs back in, we're seeing the non-equal weight or the market cap going up also. So this was kind of a different thing. We'll see how that lasts, and if these continue to go up.